Hello and welcome to Inside ETFs. I'm Ramzan Karamali. Today we're looking at emerging market ETFs with Steven Schoenfeld, CEO of MarketVector Indexes. The performance of emerging market funds has been solid, if not spectacular, this year. One of the biggest funds in this space is Vanguard's Emerging Market Stock Index ETF, VWO. However, compared to US stocks, its return seems less than impressive. The S&P 500 has easily surpassed it. In fact, US equities are outperforming almost every single country emerging market fund. And in the month after the US election results, funds that invest in emerging markets suffered net withdrawals of $8 billion, including around $4 billion exiting China-focused funds. That's according to EPFR. And with President-elect Donald Trump's vocal support of protectionism and advocacy for higher tariffs, are emerging market ETFs ones to avoid in 2025? Well, to help answer that and more, I'm joined by Steven Schoenfeld from MarketVector Indexes. Steven, thanks so much for joining us. Well, let's start with that thought. Trump's potential tariff plans could lead to a stronger dollar, so surely we shouldn't expect strong returns from emerging market funds in 2025?
So that's a sort of first order analysis. But first of all, we don't know how the tariffs will be applied and in what sequence, in what magnitude. There's been different numbers bantered around. And as soon as one country is mentioned, their head of state tends to fly into Mar-a-Lago and start the negotiations. So we have to look at emerging markets as they are now and then, of course, adjust. I think the outflow from emerging markets is, in retrospect, going to look not so smart because even though emerging markets had a rough year, especially a rough start, they're finishing the year as a whole as an asset class with positive 14, 15, 17% returns. And you've had some of the underperformers like China really have a few surges upward toward the end of the year. And so my overall thesis is emerging markets are too significant economically to ignore, but one needs to look at new approaches to get allocation to them.
You mentioned China there, and it has had a good year overall in 2024 if you look at it. But Trump has got China in his sights. He's talking about 60% tariffs. So isn't it worth considering, say, a broad emerging market fund that excludes China in 2025?
So many investors are considering that. Both the ETFs that exclude China have grown to almost 20 billion in AUM, and institutional investors have excluded China from their institutional mandates. But in many ways, this has been a lagging phenomena. They started considering China uninvestable a year or two ago, and now they've moved to a very low allocation. And lo and behold, China surprises toward the end of the year. So in my view, excluding China fully, just doing emerging markets at China is a blunt instrument. It doesn't solve the real issue for investors who should have exposure to all markets. And there's more sophisticated ways to get allocation.
So, Stephen, if you want to avoid being overweight China, which broad emerging market funds do you think you should look at instead?
So you have several large emerging markets ex-China ETFs. The largest is EM but you also have ex-SOE from Wisdom Tree, which excludes state-owned companies, but does include other Chinese companies. There are several other ex-China ETFs. But as I said, you should also supplement that with some dedicated China funds to make sure you have the right allocation that you're comfortable with for China.
And how about India? Are funds there starting to lose their shine?
Indian equities had a fantastic first two-thirds of the year, a pretty sharp correction in September with the Adani scandal and indictment. And now they're recovering. They're still going to put up a really good year. But within India, you have many dynamics. One of the areas we like the most is Indian tech. And we have an index called the MarketVector Digital India Index, which has outperformed broad India, again, almost by double. So it's important you can be in big emerging markets, you can be thematic.
Now, Stephen, in the past, we've spoken about Brazil, and it's fair to say 2024 so far has been pretty forgettable. And there is a lot of uncertainty around the country's fiscal policies going forward too. So should Brazil be one that we steer clear of again?
It's very easy to want to avoid it. And the performance this year has really underwhelmed, as you said. Interest rates are very high and could be going higher. tons of political uncertainty, not the least of which has been some health issues for President Lula. However, it is also too big to ignore Brazil. They could be benefiting from some of the changes in trade patterns, and to completely exclude it, we would think would not be wise. If investors don't want all of Brazil, they could consider Brazil small cap or Brazil domestic exposure as a safer way to play Brazil, and we recommend that.
So, which emerging market funds that we haven't spoken about do you think are worth considering?
One country that has unambiguously benefited from moving manufacturing outside of China because of the trade tensions has been Vietnam. They've continued to benefit, although they may become part of the target for the Trump administration. But I think it's unlikely they will be hit as hard because Vietnam also has a powerful geopolitical role to play for the US. So we think an allocation to Vietnam, perhaps an overweight, is a good hedge for some of the trade tensions.
Steven Schoenfeld from MarketVector Indexes, many thanks for your thoughts. And that was your look at emerging market ETFs. I'm Ramzan Karmali, and this is Reuters.